Thank you for taking your time to listen to this presentation. First, we look at what SPACs are and some of the key things to look at when selecting a SPAC to invest in. SPACs are special purpose acquisition companies or companies formed with the only agenda of acquiring other companies. SPACs typically have a period of 2 years to acquire another company, failure to which they are dissolved and investors' money refunded. Therefore, most of them have to look for a company to acquire as soon as they register. However, investors are not normally informed of the target company. Therefore, investors have to invest their money to believe that management team will acquire a performing company. This makes SPACs very risky as the investor has to only rely on the investor's words. Furthermore, most SPACs new as ideas of SPACs, despite bringing out, has only gained popularity in the recent past. Therefore, investors don't historical data to make decisions. In my case, I chose the SPACs to investigate it based on several criteria. First, I had to ensure that the SPACs had trading data of more than 2 months. The data was essential in calculating the risk and portfolio returns. Furthermore, I had to ensure that the SPACs chosen were targeting a promising industry. Some of the promising industries include electric vehicle manufacturing, advanced automation, and technology. One of the other popular types of SPACs is celebrity SPACs, which are SPACs backed or founded by celebrities. They are popular because many people trust celebrities or are willing to follow their favorite celebrity irrespective of their financial standing. I developed a celebrity SPAC portfolio to understand their market position. The celebrity portfolios were chosen based on the target industry and the popularity of the celebrity. Moving on to the next slide, we look at the performers or the weighted equity portfolio of 10 SPACs expected to succeed in the future compared to a portfolio of 10 celebrity-backed SPACs. The SPACs were chosen for the analysis include Churchill Capital Corporation 4, Burgundy Technology Acquisition, Desktop Metal, DraftKings, Horace Incorporated, Lumineer, Pershing Square Totem Holding, QuantumScape, Reinvented Technology Partners, and Stanford Barrier Acquisition Corporated. The SPACs and their weights were tabulated as above. The likely profitable SPACs had an expected return of 7.38%, while the celebrity portfolio had an expected return of minus 137.55%. Therefore, some are likely to lose the investment if they invest in celebrity stocks. One is likely to gain 7.38% annually if they invest in the SPACs expected to be successful. Looking deeper into the statistics, we find that the celebrity SPACs had a negative Sharpe ratio indicating that their stocks are moving in the opposite direction compared to the general market trends. The portfolio of SPACs likely to be profitable had a standard deviation of about 1.3%, which indicates significantly high risk due to fluctuations in the prices. The fluctuations are most likely caused by market volatility and low investor trust in the investment instrument. However, market instability also affects the celebrity SPACs. Looking at the celebrity SPAC risks, we find that the celebrity SPAC's portfolio has a standard deviation of about 0.3, indicating a considerably less risk than the other portfolio. It is worth looking at the data sets as one of the major causes of variations. The celebrity SPACs, being newly registered, had less data than some of the other SPACs that had operated for considerable time. Therefore, the deviations and returns are expected to be considerably out of touch with the other portfolio. However, the data collected was sufficient to generate a significant trend that can be used to evaluate the two portfolios. Next, we look at the result of optimizing the portfolio to increase profits. Let us first look at the optimized portfolio of the celebrity-backed SPACs. The optimization was conducted through sober evaluation that generated the portfolio weights, balancing the ways to improve the profits. However, most companies had to be shorted to form a portfolio with a positive return. Shorting involves borrowing stocks of a company to sell them when the price reduces sharply. However, shorting is only recommended for very experienced traders due to high risks that might lead to further losses. However, shorting can be used to reduce the risk associated with related stocks. The portfolio with a short position allowed was expected to yield about 30%. The returns are considerably higher than the equal weight portfolio. However, investors must understand the risk associated with shorting that can significantly affect the real result. The optimized portfolio generated without shorting was not possible due to disparities in the stock risks. Therefore, the solver determined that all the companies were too risky to invest in as they couldn't guarantee a positive return. Therefore, from the analysis, the celebrity SPAC's risks were considerably higher than the market. The Sharpe ratio was also considerably low, indicating a possibility of conforming with the market. A further look at the companies from the market perspective indicates that the companies might have been moving with the market as most economic sectors were affected by the pandemic. Furthermore, the celebrity SPACs were considerably lower than the other indexes as most of the celebrity SPACs were registered in the past few months. Now, let us look at the portfolio with the SPACs expected to be profitable shortly. The SPACs have an expected return of about 534%. Therefore, the portfolios are expected to have very high returns due to the benefits of shorting. However, as indicated before, shorting is normally very risky and requires advanced skills to pull through. About 5 portfolios are expected to be short, indicating that only half of the companies have the potential of making considerable profits. Furthermore, shorting also enables an investor to invest more than they have. Therefore, the returns are normally very high if well executed. However, since one is also investing what they don't have, there is a high chance of getting into debt if all doesn't go well. Sauber indicates that the standard deviation for the shorted portfolio was significantly low. However, a shorted portfolio requires significantly higher data sets to give the right picture. The data sets available for the analysis couldn't provide an accurate analysis. The Sharpe ratio was also significantly high, indicating that the portfolio is significantly affected by the market fluctuations, making it quite risky. The unshorted portfolio had a return of about 2%, which is significantly lower than the shorted portfolio. Furthermore, some of the companies were dropped from the portfolio when shorting was not permitted. Churchill Capital Cooperative for Heresty Incorporated and Pershing Square Taunting Holding were the companies dropped from the portfolio to reduce the chances of shorting to compensate for losses. Even though the returns were low, the risks were considerably lower. The returns were also lower than the equally weighted portfolio. Therefore, it is better to equally invest in the companies than optimizing the portfolio without shorting. The standard deviation of the unshorted portfolio was significantly lower than that of equally weighted, indicating that the unshorted portfolio had a lower risk than the equally distributed portfolio. Furthermore, the Sharpe ratio was considerably high, indicating that the portfolio highly depends on the market movement. Therefore, investors must keenly watch the market movement to predict the portfolio movement. Let us look at the portfolio compared to some of the major market indexes. The equally weighted portfolio of the likely profitable SPACs had a notable fluctuation compared to the market movement. The portfolio has a significant rise, then a drop, which has followed a rise, then a drop. Therefore, from the historic data, the stock price of the portfolio can't be fully predicted into the future. The shorted portfolio had a higher fluctuation compared to the market, indicating a very high risk level. Therefore, investors must take caution when investing the companies with a shorting option. However, the unshorted portfolio had a significantly lower fluctuations compared to the Nasdaq and S&P index. The Nasdaq and S&P index normally followed market trends. Therefore, unshorted portfolio had a higher correlation with the market. Therefore, investors can use the market index as a benchmark before investing in a portfolio. Considering the graphs of the several stocks against the two indexes, most of the companies in the equally weighted portfolio had a significantly stable graph compared to the market indexes. However, the returns had a lower trajectory, indicating that an investor is likely to lose money or get very lower returns compared to the market indexes considered. The shorted portfolio had a curve with a very low correlation with the market indexes. The portfolio comp was majority on the lower position of the graph, indicating negative returns at all times. Therefore, based on the data, investors should avoid investing in security stocks even if they are shorted. The unshorted portfolio had a straight line on zero as returns were expected to be zero if no investment was made. However, Nasdaq and S&P indexes had a significantly stable graph as they are normally affected by similar market conditions. Now look at the relationship between our SPAC portfolio and the three common exchange-traded SPAC indexes. Currently, there are only SPAC ETFs in the market. Therefore, most of them are very new since the popularity of SPACs has only risen in the past 18 months. For this analysis, the three SPAC ETFs include Defire's Next Gen SPAC Derived ETF SPAC and the New Issue ETF and Morgan Creek Exoc SPAC Originated ETF. The equally weighted portfolio had a significant resemblance with the three chosen ETFs for the likely profitable SPAC portfolio. However, the equally weighted portfolio had a higher fluctuation compared to the chosen SPAC ETFs. The shorted portfolio had a very high fluctuation compared to chosen SPAC ETFs. Therefore, the risk of investing in a shorted portfolio was significantly high. The unshorted portfolio was consistent with the chosen SPAC ETFs with a slightly fluctuation in the beginning. However, the portfolio had a lower trajectory than the other SPAC ETFs, indicating that the returns are expected to slow down. The equally weighted portfolio of celebrity SPACs also had a close resemblance to the chosen SPAC ETFs. Both groups of companies had a low trajectory. The reduction in prices may have been a result of market instability caused by the pandemic. For the shorted portfolio, the two groups of portfolios had a significant difference. The celebrity SPACs had a graph on the negative side as the returns were mostly negative. The unshorted portfolio had zero returns. Therefore, the comp was a straight line at the zero levels. From the analysis, it is clear that most of the celebrity SPACs were not a good investment option due to low returns and high risks. Therefore, investors must be careful when investing in celebrity-backed SPACs.